Welcome to Beyond Just Money by Kalkinemedia, an independent global media house and investor relations group. Please note that this podcast is for information purposes only. It's not a solicitation or recommendation to buy, sell, or hold the stocks of any company or companies or engage in any investment activity under discussion. Kalkinemedia is neither licensed nor qualified to provide investment advice through this platform.
Hello and welcome to Beyond Just Money. My name is Santa and with me today we have Nidhi Sinha. She's the head of content for Kalkinemedia. And as we know that companies generally raise additional capital by using additional shares. However, it results in diluting the existing value of stocks, raising concerns for shareholders. Hence, companies consider issuing stock rights and warrants to raise additional funds. These financial instruments give shareholders the preemptive right to buy additional shares of stock directly from the company, generally at a discounted price. So, to discuss this, we have Nidhi with us. Welcome to the show, Nidhi. And could you please tell us that what are these stocks rights and how are they issued?
Thank you, Samta, for having me on the show. So when we talk about stock rights, they are financial instruments which provide the owner the right to purchase shares of a company at a specific exercise price for a designated period. Stock rights basically give shareholders an opportunity to protect their fraction of corporate ownership. Companies issue single right for each share. Each right can be used to buy a fraction of a share so that multiple rights are needed to buy a single share. Immediately after the right is issued, the underlying stock trades with the right attached. It is referred to as rights on. Thereafter, the right will separate from the stock and the stock then trades rights off until the rights expire. Rights generally expire between 30 and 60 days of issuance. The exercise price of rights is always set below the current market price.
So Nidhi, companies also issue warrants. What are warrants and how are they different from stock rights?
Well, a warrant is a long-term financial instrument that entitles the holder to purchase the underlying stock of the issuing company at a fixed price, which is called the exercise price, until the expiration date. Unlike stock rights, warrants are generally issued with an exercise price above the current market price. Warrants are usually assigned a waiting period between 6 months and a year. A long waiting period gives the stock price time to raise enough to surpass the exercise price and provide intrinsic value. Warrants are used to boost the yield of the bond and make them more attractive to potential buyers.
So would you like to tell our listeners what is the difference between rights and warrants?
Samta, before I talk about the differences, let's talk about the similarities. Both with stock rights and warrants, shareholders hold these for the time being. They can even buy additional rights or warrants in the secondary market. The shareholders also have an option to sell these two financial instruments to another investor. Besides, they can even allow their rights or warrants to expire. Coming to the difference, stock rights allow the shareholder to buy more shares directly from the company at a price lower than the current market price of outstanding shares. Usually, rights expire after a few weeks from their issuance. Warrants are long-term instruments that allow shareholders to buy a stock at a discounted price. So, for example, company ABC issues stock warrants to new hires having a structure of 100 shares at the strike price of $50 per share within 3 years. Now, the stock warrant gives the holder the right to buy up to 100 shares of ABC at $50 per share, even in the scenario when the current price of ABC exceeds $50 per share. However, the warrant will expire after 3 years.
Well, Nidhi, how does taxation work for these then?
Rights and warrants are generally taxed on the same lines as any other financial security. The tax applies on the difference between exercise and sales price of the securities, which are taxed as long or short-term gain. However, the issuance of both rights and warrants have reduced to a large extent in the past few years. Both these financial instruments are not in much use today due to increase in popularity of stock and market options. Investors are advised to consult their financial advisors before developing their investment strategy around rights and warrants.
Thank you so much, Nidhi, for discussing with our listeners today on how companies raise capital via stock rights and warrants.
Thank you, Samta.
Well, to listen to this podcast again, please log on to our website, that is kalkinemedia.com, or you could go on our YouTube channel. Please do not forget to like, share, subscribe, and hit that bell icon to get notifications on the latest videos and podcasts. Until we see you next with yet another insightful episode of Beyond Just Money, this is me, Samta, saying goodbye. And as we always say, stay apprised and invest wise with Kalkine, your best guide.
Our listeners are requested to make their own inquiries about any investments, and Kalkine Media strongly suggest that the listeners seek advice from a financial advisor, stockbroker, or other professional as necessary. Kalkine Media hereby disclaims any and all the liabilities to any listener arising from any use of the information shared or discussed in this podcast. This podcast is available for personal and non-commercial use only.